Hey everyone, how's it going? JD Strategic here. I hope everyone's doing great today. This video, I'm going to be talking about a few of my key takeaways to be a successful investor. Everyone has all these stereotypes that it's something's challenging, it takes up a lot of your time, you need to be an expert, but it really is something that's simple and straightforward and doesn't take up a lot of your time. It really is, you craft that plan up front. It really doesn't require a lot of time. It really is just something that you have that plan and then you never have to worry about it again. You just have these recurring investments that help you generate wealth throughout your journey and whatever you're doing. We don't have to get caught into all these TV personalities, what the analysts are predicting on a daily basis, what stocks or bonds to buy or sell. Because overall, if you're buying and selling on a daily basis, you're just adding extra expense fees that you don't need. And the intelligent investor teaches us that you want to cut down on expenses as much as possible. So with that being said, I want to get into a quote by Peter Lynch, who spent his career at Fidelity, and he's one of the greatest investors of all time. If you don't know him, I strongly suggest you look into him. He's very interesting. He wrote the book One Up on Wall Street, which is very interesting about how you don't need to work on Wall Street to beat the people that work on Wall Street. So this quote kind of ties into that idea. And it's good or bad investments are about your response rather than what you read on Wall Street. So it's about how you're reacting to certain things. So this ties back into this idea of the stock market and being successful. It's all about the psychology. So when people are buying and selling like crazy, you kind of just got to stand back and react accordingly. You have that long-term plan, and you're not getting caught up in the day-to-day speculation, because overall the stock market really is just like a distraction to actual investing. Investing really isn't something that's flashy. It's really just you're putting money in like index funds, nothing crazy. You're kind of just accumulating wealth over time. It's not something you're spending your daily basis on. You don't need to be trading to accumulate wealth. It really is something that it's a process, and that is why so many people struggle with investing. Everyone wants the results now, but it really is a matter of compounding, and you need to put in the work for a while before you really start to see your money compound, and that's where you start to get excited about investing. So with that being said, let's get into this video. So this is who I want to talk about, Jim Cramer. So he's a TV personality that hosts the show Mad Money. It's on CNBC, and he does this every single day. And basically, this is just his net worth online, but overall, I've heard a lot of this stuff isn't accurate, but it just shows he is making a ton of money. And this is someone that's actually very, very educated. He was a former hedge fund manager throughout his career. He graduated from Harvard. So this isn't like anyone that just like got the job as a TV personality. He has a credibility as an investor. He's had success in the hedge fund industry. But that just goes to show the point that you don't want to follow in these people's footsteps. Because let's look at his returns. Okay, so in blue you can see where $1,000 into Jim Cramer's portfolio would have got you from 2001 to 2017, versus gray dotted line where if you would have just put it into the S&P 500 index fund. So if you would have put it into the S&P, that would have been over $3,000, where if you would have put it into Jim Cramer's alerts, it would have been worth $1,900. So that's a dramatic difference, and that's just over a 17-year period. So when you think about investing over that 40, 50-year period, the idea of compounding is like this difference right here is going to be worth so much more in just a couple of years. So it does go to show you want to stick with that long-term investment plan. You don't need to overreact. You can just invest in index funds. You don't need to pick and choose individual stocks. So it really is interesting. They have this show where it's been going on for years now, if not decades, and it's literally just him basically screaming at a TV telling you what to buy and sell. And it's proven over time that if you don't listen to these TV personalities, you just stick to your long-term investment plan, that you'll have a lot more success. So these are a couple of my few key takeaways just from watching some of these TV personalities and actually kind of looking into their stock picks and some of their success they've had. Whereas if you would have just invested into an index fund. And what's interesting is a lot of the stocks that these people are telling you to buy and sell, you already have exposure through them if you're invested in just the S&P 500 index fund, because this tracks the 500 greatest companies in the US. So majority of them are going to be the stocks that these people are talking about. So one other interesting point I want to talk about is that if there was one person out there that was able to tell you guys what to buy and sell and was able to consistently beat the S&P 500 over time, there wouldn't be a need for hundreds and thousands of portfolio managers and investors across the country. You know, if there's one person that could do it, you wouldn't need so many people trying to tell you that they can beat the benchmark. So overall, it's about just sticking to that long-term investment plan, investing in the benchmark rather than trying to beat it, because if the experts can't do it, then why should you or I try to even do that? It really doesn't make a lot of sense, especially when you look at over time. You know, you can beat the benchmark for a year, for 2 years, for 3 years. But when you look at 10 years, 15 years, 20 years, it really just doesn't make sense. And then when you think about all the added extra effort that goes into buying and selling all these stocks, whereas you can literally just put your money into an index fund that tracks all these companies and have a lot more success. So it almost seems like the definition of insanity, where we're always just trying to beat the benchmark, but we've kind of learned it's really not possible. You know, if one person was able to do it, we wouldn't be paying so many people to try to do it. So, you know, always stick to that long-term investment plan. Investors are always going to be changing their outlook on the market, and the market's always going to react differently. You know, throughout 2020, we watched a lot of these big companies report great earnings, and then the next day the market their stock price would fall. So there is no telling what the market's going to do in the short term, but in the long term, if we just stick to those index funds and that investing in the benchmarks rather than trying to beat the benchmarks and picking our own individual stocks, it does show that we'll have the greatest success overall. So that's really everything I wanted to talk about today. It really is just about sticking to that long-term investment plan, not following the herd. Just like anything else, you want to stick to your own gut rather than following what everyone else is doing. So these are a couple of my few key takeaways that has had me had a lot more success with my investing career. So I hope you guys found this video helpful. JD Strategic out.